Hey everyone, welcome back to this deep dive into Peter Lynch's Beating the Street. If you have been following our journey through this book, you've already know what we've covered with some mind-blowing lessons in the first two chapters. So today we are stepping into chapter 3 and there's a lot to unpack. So let's dive in. So Peter Lynch kicks off this chapter with a pretty hilarious reality check. Mutual funds were created to simplify investing. Like, hey, don't worry about picking individual stocks. Just put your money in a fund. Simple, right? But now there are thousands of mutual funds. I'm not even joking. He mentions over 3,500 mutual funds at that time. So with every flavor you can imagine, equity, bond, hybrid, sector-based, country-specific, even funds of funds. It's like a mutual fund buffet. And now you're stuck wondering, which one do I even pick? So Lynch walks us through how he and a team of seasoned investors helped a non-profit restructure its portfolio. The idea was simple. How should a regular person decide the mix between stocks and bonds? Now here's a key insight Lynch gives us. Most people over-prioritize income and under-invest in growth. He says this is a huge mistake, especially in the long run. Back in the 80s and 90s, more and more people were flocking to bonds. But Lynch argues that's short-sighted. Historically, stocks have returned over 10% annually, while bonds gave just under 5%. So if you want to build real wealth, stocks are your best friends. And here's where he drops a gem. Dividend-paying stocks that consistently increase their payouts are a gem. He even references Moody's Handbook of Dividend Achievers, a list of companies that have raised their dividends from 10 or 20 years straight. There's even a fund that allows this strategy, Putnam Dividend Growth. So here Lynch explains it perfectly. Companies grow, profits increase, and dividends rise. But bonds, nope. Bondholders don't get bonuses or dividend hikes. They just hope inflation doesn't eat their returns alive. Now he acknowledges that older people are more into bonds because they rely on interest income. But here's the kicker. People are living longer now. A healthy 62-year-old might live another 20 years. So relying solely on bonds could actually hurt you. Why? Because of inflation. So he gives this picture of a retired couple with $500,000 invested in bonds and cash deposits. Sounds safe, right? But if inflation kicks in, their buying power drops drastically. In 10 years, their $35,000 income could feel like $17,000. So Lynch recommends increasing your stock allocation as much as your risk tolerance allows. Even if you need income, he says it's smarter to own stocks that pay dividends and sell small portions occasionally than to rely purely on bonds. And here comes the legendary part. Lynch works with Bob Beckwith from Fidelity to crunch real numbers. So they look at all three cases. Case A, all in bonds. Imagine you invest the full $10,000 in bonds paying 7% interest. Over 20 years, you earn $14,000 in interest. But that's it. You just get that interest plus your original $10,000 back. So in total, you walk away with $24,000. And case B, half bonds, half stocks. Now let's say you split your $10,000, half in bonds, half in stocks. The bonds still earn 7% and the stocks are paying a 3% dividend and growing at 8% per year. After 20 years, you've earned about $10,422 in bond interest and about $6,864 in dividends from the stocks. Your total portfolio value, $21,911. So yes, you earned income from both sides, but the total didn't grow as much as you might expect. Here comes the case C, all in stocks. This is where it gets interesting. If you invest the whole $10,000 in stocks with 3% dividend and 8% annual growth, you end up with $13,729 in dividends, and your portfolio is now worth $46,610. That's nearly double what you got in case A with just bonds. He even goes one step further. What if you need $7,000 a year for living expense and you only got $3,000 in dividends? Just sell $4,000 worth of stock. And guess what? As your dividends grow, you'll need to sell less. By year 16, your dividend alone gives you more than $7,000 a year. And after 20 years, your $100,000 becomes $349,000. even after spending over $140,000. Now, of course, Lynch admits stocks aren't a smooth ride. Markets crash, portfolio drops, but as long as you hold and don't panic sell, you'll almost always be better off than sticking with bonds. He also busts some myths about the bond funds. People think they are safer than individual bonds, but they are not. Bond funds still lose value when interest rates rise, and they often charge fees that eat into your returns. Peter Lynch says if you must own bonds, buy them directly. Treasury bonds, to be specific. No fees, and you know exactly what you're getting. But bond funds, not the case. Next up, we go from bonds to stock funds. And this is where Lynch gets real. Just because you invest in a mutual fund doesn't mean you'll sleep easy. In fact, great mutual funds can fall harder than the market during corrections, but bounce back even stronger. The key is don't panic. And here's Peter's principle. If you're going to pick a fund, at least pick a good one. But how do you do that? Lynch gives us multiple insights. Most mutual funds underperform the market. Some managers are just bad stock pickers. Others copy index funds but still charge high fees. And sometimes big companies in the S&P just might have had a good run, which makes it harder for actively managed funds to beat the index. So should we all just buy index funds? Maybe. Over the long term, they've often beaten managed funds. But Lynch says if you do your own homework and pick the right managed fund, it can outperform. He also suggests diversifying across different types of funds. And let's see one by one. Capital appreciation funds. These are the wild cards. The fund manager has the freedom to pick any stock from boring to bold. If they're good at it, great. If not, it can be messy. High risk, high reward. And the second is value funds. These go for companies that are underpriced. Maybe the company owns a ton of valuable land or patents, but no one's paying attention. This is like finding a house that looks average but has hidden treasure in the basement. And the third is growth funds. These are fast-growing companies. Think tech companies or big consumer brands. These often come with a high P/E ratio, which means price to earnings. It tells you how much you are paying for every dollar the company earns. A high P/E might mean investors expect it to grow a lot, or that it's just hyped up. And the fourth is emerging growth funds. These focus on smaller companies that are just taking off. They're exciting but risky. Some might flop, others might become the next big thing. Special situation funds. These look for unique events, maybe a merger, a turnaround, or a new product launch. The fund manager bets on this change, helping the company's value jump. Peter suggests a smart strategy here. Split your money among 5 or 6 different kinds of funds. That way, you're not putting all your eggs in one basket. You won't guess right every time, but you'll always have some part of your money in the winning side. And if you want something super simple, go for index funds. They don't try to beat the market, they just follow it. And over time, that beats most active fund managers. A lot of people pick funds based on past performance. Oh, this one did great last year, I'll buy it. But research shows that this rarely works. Last year's star fund can be this year's worst. What matters more is consistency, how the fund performs during both good and bad times. Peter Lynch recommends checking out the Forbes Honor Roll. They rate funds not just on how high they go, but how well they hold up when the markets gets rough. And then there are sector funds. These are funds that invest in one specific industry, like gold, biotech, or energy. They sound cool and they also really go fast, but they can crash just as fast as too. Peter says unless you are an expert in that field, it's better to avoid them. Like if you're a doctor and understand biotech, go ahead, otherwise maybe not. Then there are funds based on countries, like a German fund or an Italy fund. Sounds exotic, right? But these can swing wildly because of politics or sudden economic changes. Peter Lynch shares how German reunification caused German funds to spike and crash within 6 months. Timing these, super tricky. Convertible funds, a cool middle ground. These are part bond, part stock. You get interest like a bond, but later you can convert into a stock. So you get some stability, but also the chance for growth. Peter Lynch likes these two. It's like having a foot in both worlds. So here's the summary of Peter Lynch's mutual fund strategy. Prefer stocks to bonds, especially dividend growing ones. If you must own bonds, buy individual treasuries, not bond funds. Know your funds category and compare it fairly. Diversify across fund types. Add new money to sectors that have underperformed recently. Don't obsess over past performance. Consistency matters more. And before wrapping up, Lynch offers solid advice. Don't chase past performance. Don't switch funds constantly. Understand what kind of fund you own. Finally, diversify, be patient, stick with consistent performers. That's it for chapter 3. In the next video, we are heading into Lynch's personal journey of managing the legendary Magellan Fund. You don't want to miss that. So if you like this video, give it a thumbs up, subscribe, and hit that bell icon to stay updated. Till next time, keep learning, stay calm, and remember, be consistent, not fearful.